Ever wonder how global megacorporations actually figure out their tax bills? It's a massive question, right? And honestly, the answer dictates whether these giants end up paying their fair share to fund the national budgets, public infrastructure, and the roads we all rely on every single day. So, welcome to this explainer. Today, we're unpacking a highly complex but absolutely fascinating topic: how corporate groups manage their taxes through corporate tax consolidation and group relief. Let's get right into it.
Picture a hypothetical corporate empire. We'll just call it Omnicorp. Say Omnicorp owns 100 different subsidiaries scattered all over the world. You've got one division handling manufacturing, another doing digital marketing, and maybe a third strictly holding real estate. So here's the core dilemma of modern corporate structures. Is Omnicorp one single business, or is it 100 completely separate businesses? How should the law actually treat them? Well, the fundamental problem governments face here is a huge clash between legal structure and economic reality. Under the law, each of those subsidiaries is a separate legal entity. But if governments tax them strictly in silos, it creates some massive inefficiencies. Think about it. Let's say Omnicorp's highly profitable software division is paying a 25% corporation tax, while their physical retail division, literally right down the hall, is bleeding money. In the real world, they're operating as a single economic entity, basically one giant machine. Taxing them completely independently just ignores the actual economic reality of the whole business.
So the global solution to this problem is called tax consolidation. Basically, this is a tax regime that takes that whole umbrella of companies and treats them as a single entity for tax purposes. It's really a system designed to cut down on compliance costs for the business, reduce the administrative headache for the government, and, most importantly, align their tax liabilities with the actual real-world economic reality of the enterprise.
Now, governments don't just let any two random companies team up to shrink their tax bills. There are rules. In the UK, for example, 75 is the magic number. It's the absolutely crucial baseline. If a parent company beneficially owns at least 75% of a subsidiary's ordinary share capital and has rights to 75% of its profits and assets if it ever winds up, well, boom, they form a recognized tax group. This 75% threshold essentially acts as an economic umbrella, allowing these legally separate entities to start legally sharing their tax burdens. Okay, let's look at the first major way they do this. Section 1, sharing losses through group relief.
Let's follow the money and ground this with some simple math using our Omnicorp example. Let's say the software wing had an amazing year and generated a profit of £1,000. Normally, they'd pay tax on that entire £1,000. But the retail wing had a really rough year and suffered a loss of £100. Because they're both sitting under that 75% tax group umbrella, group relief allows the software wing to actually offset its profits using the retail wing's losses. The end result? The Omnicorp group only pays tax on the aggregate amount, so £900. The economic unit is taxed on its true economic outcome. Make sense, right? The actual mechanics of how this happens behind the scenes are pretty clever. You essentially need two parties: the surrendering company, which gives up its loss, and the claimant company, which uses that loss to lower its own tax bill. Generally speaking, both of these have to be UK-based. And to keep the individual company's books balanced, the claimant company usually pays the surrendering company for the tax they just saved. Here's a really fun bit of tax irony for you. A company literally buys a loss with cash, and the tax man completely ignores the payment. Yeah, it's not taxable income for the loser, and it's not a deductible expense for the winner. It is a totally tax-neutral transaction. But as you might guess, governments don't just write blank checks. Back in 2017, a major catch was introduced. If a corporate group is pulling in massive revenues, we're talking making profits over £5 million, they hit a ceiling. Above that £5 million threshold, companies can only offset 50% of their profits against carried forward losses from previous years. It's basically a mechanical rule designed to ensure that large, highly profitable corporations always pay some baseline level of tax every single year, regardless of whatever historical losses they might be carrying.
Moving right along, let's jump into Section 2, moving assets and capital gains.
So, corporate groups don't just share profits and losses. They also move massive assets around all the time. If Omnicorp's parent company decides to transfer a highly valuable piece of real estate, or maybe a patent, to a subsidiary, a normal transaction like that would trigger a huge capital gains tax bill. But within a group, we use something called the nil gain/nil loss rule. The law brilliantly fixes the sale price at the exact amount that results in zero profit and zero loss for the transferring company. The receiving company then simply takes over the original tax cost of the asset. Seamless.
Now, I want to make something absolutely crystal clear here. This is not tax evasion. The tax is simply deferred. The government recognizes that shifting a factory from your left pocket to your right pocket hasn't actually created any real-world wealth. The true economic gain is still captured, and it will be taxed eventually, but only when the group finally sells that asset to an outside third-party buyer.
Okay, next up, we have to look at the day-to-day transactional friction. Section 3, VAT grouping simplified. While corporate tax is paid annually, value-added tax, or VAT, is charged on daily transactions. Just imagine the sheer administrative nightmare if Omnicorp had to issue a legally compliant, taxable invoice every single time the HR department poured a cup of coffee for the manufacturing team. It would be chaos. VAT grouping eliminates this massive paperwork burden. Here's how it works. Step 1. The group appoints a representative member. Step 2. That member submits a single, unified VAT return for everybody. And Step 3. All supplies of goods and services between group members are just completely ignored for VAT purposes. Easy.
But of course, there is a catch. The trade-off for all this wonderful administrative ease is something called joint and several liability. By forming a VAT group, every single member of that group becomes legally on the hook for the entire group's VAT debts. So if the representative member goes bankrupt and owes the government millions in VAT, the tax authorities can just knock on the door of literally any other subsidiary in the group to collect the full amount. It's a pretty serious commitment. Now we reach the guardrails. Because governments certainly don't give corporations a free pass. Section 4, the limits and interest restrictions. When you picture the massive scale of worldwide corporate operations, you can easily imagine the incredibly complex financial webs they weave. A really common strategy in the past was loading up a subsidiary in a high-tax country with debt that it owed to a subsidiary in a low-tax country. The high interest payments would conveniently wipe out all the profits in the high-tax jurisdiction. To combat this whole global cat-and-mouse game, internationally coordinated base erosion and profit shifting, or BEPS, initiatives gave birth to the corporate interest restriction rules.
To ensure they don't accidentally catch small, everyday businesses in this incredibly complex net, the UK set up a safe harbor. This $2 million figure is the minimum interest capacity for a 12-month period. If a UK group's net interest expense is below $2 million a year, they usually don't face these restrictions and can just deduct their interest normally. But if you are a massive multinational like Omnicorp borrowing heavily, you're going to blow right past this limit.
If a group does exceed that $2 million allowance, they are forced to calculate their tax deduction limit using one of two methods. The default is the fixed ratio method, which caps their interest deduction at 30% of their taxable earnings, essentially their earnings before interest, taxes, and depreciation, which is known as tax EBITDA. Alternatively, they can use a highly complex group ratio method, which bases the limit on the worldwide group's external borrowing profile. Either way, these rules strictly prevent groups from artificially wiping out their profits using excessive internal debt. Furthermore, the UK tax authority actively monitors for abuse with some very strict anti-avoidance rules. You absolutely cannot claim group relief if there are artificial arrangements in place. For example, if you're about to sell a loss-making subsidiary to a third party, you can't just harvest their losses on their way out the door. Actually, scratch that. It's more like trying to strip the copper wire out of a house right before you hand over the keys. The government won't let you do it. Likewise, any losses generated from unallowable tax avoidance schemes will be stripped away entirely. The rules are there to reflect genuine economic reality, not to facilitate fancy tax engineering.
So, what does this all mean? Well, tax consolidation and group relief are incredibly powerful tools that attempt to align rigid legal structures with fluid economic realities. But as we look to the horizon, a massive challenge is looming. In a future where digital corporations can exist entirely in the cloud, operating frictionlessly across dozens of countries, how can physical national tax borders possibly keep up? Are we looking at the eventual end of the corporate tax group as we currently know it? It's an incredibly delicate, ever-shifting balance between taxing true economic reality efficiently and stopping multinational tax avoidance. Thank you for joining me on this explainer today, and as always, keep asking the big questions.